topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities, In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond.
Hello everyone, great to see an amazing audience, and I'm sure that a lot of people are also following the live stream, so good afternoon, good evening, wherever you are in the world. There has been a theme going on very heavily during this COP, every single day, every hour of the day, at multiple places around climate finance. So the gigantic amount of investment that is still needed on this topic today and in the future, with an importance which is only growing, makes this topic central. The good news is that the amount of investments has been growing during the last years, plus 10% yearly on average. The bad news is that it needs to grow much faster because we're not there yet. We need to go from plus 10% to plus 30%. That's easily said than done, because this isn't new. And still we can ask ourselves, why haven't we achieved the plus 30% or equivalent in the previous years? The reason is quite simple. There are many barriers to this. Some of them are linked to the complexity and the nature of risks. Some of them are linked to the volume and amounts of investment that is needed. Some of them is linked to the patient capital and impatient capital and how we build bridges between the two of them. And some of them are linked just to knowledge capacity gaps that we have across the globe. The other thing is that this gap is so big that it's present everywhere. It has a nature or a geography nature. We have gaps in mitigation, we have gaps in adaptation, and we have gaps across almost every single sector. So to talk about this topic and to talk about the role of development finance institutions today, we have a great panel with us. So we have Wendy Woods with us, BCG Vice Chair in charge of sustainable social impact and climate and sustainability. We have you, Stefan Wendels, the CEO of KfW, and we have Adamasu Tadise, the CEO, President Emeritus of TDB, Trade Development Bank. Thank you for being with us. And I am Amin Benayad, a Managing Director and Partner at BCG, looking after our climate and sustainability practice for financial institutions globally. Please welcome our panelists. We will have 3 moments in this discussion today, 3 keynotes. We propose to structure this the following way. The first keynote will be given by Wendy, and Wendy will talk about our joint paper with KfW around the climate financing roadmap and how DFIs can build bridges to unlock the private capital. Then we will have a second moment, a second keynote by you, Stefan, around the role specifically of KfW as a transformation agent and as a promotional agent in this whole ecosystem. Last but not least, Admasu, you will share also in your keynote your perspectives on the mandate of DFIs globally and how they can ensure to measure the measures for socio-economic development, that these measures continue to be also climate positive in the long run. Between each keynote, we will have Q&A. I will be asking some questions, and we will open up for audience questions at the end. I hope this works for you, and let's start with you, Wendy.
Thank you, Amin, and I am so pleased to be here today and presenting the joint work that BCG and KfW have done together in our partnership. Let me get to the right starting point here. We have been working the last few months on a publication together. We all know the challenge is moving more money more quickly to the right places. That is not an easy challenge. We know we need more instruments, we need more innovation, and we need more ways to both de-risk the funds that are going to flow if we're going to get more private sector money flowing into those. And we know we need to build the partnerships on the ground that are going to enable the development of the project pipeline that is actually bankable, that is actually appropriate for private sector finance. So what did we do as KfW and BCG to actually help push the thinking and the themes on this? Well, the first thing I want to talk about is we tried to provide a big picture perspective on the issues, the challenges, but more importantly, the levers that we can all use that are going to accelerate the private sector investment. We realize that this is by no means the last word on the topic. There is a lot of innovation that we are going to need to do from here. And frankly, we relied very heavily on this work, on the bright spots of innovation that are happening in many DFIs around the world. And so please take this as a collection of what is happening in the best circumstances and a challenge, frankly, to all of us to continue to push the envelope on what we can do together. So what does this challenge require? What does it mean to move more money more quickly to the right place, to leverage both the public funding that we have, but leverage and improve and expand the amount of private sector funding? Well, from a DFI perspective, it means at least 2 things. It means transforming the way we think about our business model, the products and services, our strategy, our impact, and frankly, the way we distribute and cooperate to do that well. It's the business side of a DFI model. But there's also an operating model. The only way we transform our business and the products and our offerings is if we also transform our operating model. How do we think internally about pushing the flexibility, the adaptability, bringing in the newer tools that we need, digital, to accelerate the knowledge base of our teams, filling those gaps and enabling us to pivot more and act not just on what we think we should do, but what we can learn and what we're actually delivering. Performance-based incentives on mobilizing private capital, not just getting the public capital out the door. There is so much we can do, both on the business model side and on the operating model side. I want to get into just a little bit of that now And Amin kicked it off very well. We all know the challenges that are existing. Frankly, what makes it even more complex is that, frankly, all of those challenges are interrelated, and they play on each other to make any one of them harder and harder. But if we think about what we can do on the business model transformation side, how do we expand our products, our offerings to deliver more, and to deliver more on the private finance side, not just the public sector side? How do we think about that? We've all been hearing about all the risks: technology risks, regulatory risks, foreign exchange risks, and country-specific political risks, right? It's our collective challenge to find ways to mitigate all of those risks. But if I think about some of the things that I've been thinking about and hearing most about this week, let me just highlight one. And I want to talk about that currency risk, the foreign exchange risk that we all deal with, right? The most innovative DFIs, how do we actually do more with hedging that currency risk? How do we think about learning from what IFC is beginning to do, MIGA is beginning to do, to actually create better hedges, better guarantees, to actually manage more of the currency risk, and in some cases with MIGA, the political risk that we're seeing? How do we expand that piece of our portfolio? How do we expand the consortia side of our portfolio and build those platforms where we can work together to take products that we know have potential but aren't yet investable, aren't yet bankable, to actually develop those projects together to a pipeline that is investable? One of the things that I'm excited about is one of the things that's been coming in from the US side of things on the Energy Transition Accelerator. US State Department and a number of foundations working to figure out how to bring private sector financing to decommission coal, build renewables across the low-income countries. Can the DFIs play an even bigger role in things like the ETA? To do that, it means thinking about our impact measurement differently. I mentioned it up front, but it's about thinking about impact measurement in a predictive sense. Can we use the latest tools to understand better what the likely impact of our funding will be, and therefore tailor our funding to the places that will actually have even more impact? Can we actually do more to create more transparency around the impacts that we're having? And frankly, be willing to hold ourselves even more accountable for delivering that impact. For that distribution model, how do we bring in more digital? It can create the transparency, but it also can create those syndication platforms that enable us to distribute even more effectively. There is so much we can all do enabling public financing to catalyze when we're much, much more innovative and adaptive. But I said to do that, we need to think about how we actually change the operating model. How do we change the incentives for how we work? How do we actually, as I mentioned, create incentives based on not just the finance that public institutions put out the door, but what gets mobilized on the private side? We know that we can actually track that now. We know we've got the tools to understand what we're catalyzing with public finance. How do we make sure that we create the incentives for the ultimate impact measures we want, not just the intermediate steps along the way? How do we harness that technology? How do we actually cultivate talent? How do we actually fill the knowledge gaps? There's so much we can do by leading with flexibility, adaptability, and the right incentive structure around this to really change the way that our organizations all work. Now, there are ways that the public sector can help too. And one of the things that we've spent some time on in this publication is thinking about the dashboards. And most people think, oh, reporting, it's a boring piece. In some ways it is, but creating the transparency, creating the visibility to target the investments by sector in the places that are going to make the biggest difference, actually really thinking hard about the measures and the KPIs that we need to be tracking, and actually making sure that we are constantly tracking the ultimate numbers on where we're getting in terms of where Amin started, with what kind of coverage do we have against the financing needs on a sector-by-sector basis in the areas that need to be decarbonized first. There is so much that we can do together. One thing that we've learned very clearly from this report is there are tremendous bright spots with every institution that we talk to. And we did many conversations to inform, many interviews to inform this report. But frankly, those bright spots aren't proliferating nearly as quickly as possible. So how do we actually proliferate the bright spots and the leading edge of what's happening within every institution? And then how do we come together to push the boundaries of that even further with what we all do together? Thank you very much. I'm going to hand back to you, Amin, and I think you're going to get all of us up here if I can invite Stefan and Nadmasu to join us up here.
Yes. Thank you, Wendy. Thanks a lot. Stefan, can I invite you to join us on stage? Thank you very much, Wendy, for this presentation. So, two topics. I think you laid it out very well: the business model and the operating model. And Stefan, I'll go back to you first, maybe on the business model part. As Wendy shared with us, the products and services portfolio can be also an enabler to lower some of the barriers that this topic is facing. Could you tell us, Stefan, a bit more about how you concretely do it and how you concretely make it work at KfW?
Yeah. Good morning and good afternoon, good evening to those who attend us via video. KfW is the largest, outside China, largest DFI, if you want, the national DFI in the world, with 40 billion of equity, more than 600 billion balance sheet, which gives us a relevance, which I think is important to use in this decisive moment which you described, because we need to speed and scale, and nevertheless it's a marathon. KfW looks back to 50 years of experience working together with private investors, and that is a big advantage. And the challenge which we face is how do we reduce those barriers which Wendy described. There are certain risk categories which are outside a responsibility of a bank, and there are certain risk categories which we can address. And to address the investment risk, we have made great experience with blended finance, of course, but blended finance, i.e. taking the first loss piece in a certain fund, is expensive. It's expensive from a government point of view because the risk of the second layer is not always appropriately priced. And that's a big challenge, in particular in Global South or emerging markets. The cost of capital is simply high, and there is a lot of misunderstanding of investment requires if you look at the data. We have more than 1,000 investments globally in terms of equity. It's a fine portfolio, but to attract private equity is still a challenge. So blended finance will remain definitely important. Secondly, I think cooperation with insurance companies, that's an area which is underdeployed, because banks and insurance companies often do not speak the right language. But if you want to reduce the risk, better speak to the insurance industry. They understand the risk, and it's their task to price many risks which we face. And climate risk is a big factor, increasingly in terms of the overall cost of capital. And thirdly, I think it's important that we create scalable opportunities. Investors love size and liquidity. And little projects, it's very hard to attract private capital. So if we jointly can, with our partners on the ground, and you said we need partners on the ground to make these projects bankable, size, liquidity matters, and therefore often also pan-country initiatives are important. And last but not least, fourthly, I'm strongly believe and see a paradigm shift in terms of cooperation and collaboration. We have more than 250 DFIs globally. A lot of DFIs have an independent strategy, and we are much stronger together. And let's win together than losing alone. Let's jointly prioritize and employ the scarce resources which we have in order to attract as much private capital as possible.
Thank you very much, Stefan. We'll come back to the DFIs with you, Admasu, but let me follow on with one question. Um, one of the points you made around scale and around the fact that small projects, many of them, won't make a difference when trying to talk to private sector and private investors. Could you share more with us on what are the impediments and what are you trying to do to reach that scale?
Yeah. What we try is, of course, firstly, we work with prime partners and global asset management companies, whether it's Allianz Global Investor or BlackRock, name it, because they have access to large pools of financing, and that is the starting point. Secondly, I think, based on my experience in more than 25 years in banking, we should listen first to investors, what they need in order to invest. It's not us to define what they should do. They take the decisions, and they have often investment criteria which is not well understood on our side or the public sector, because we haven't spoken with each other. I come from the private industry. I'm used to work with investors, listen first, and then design the product. And thirdly, I think we should encourage pan-country, pan-regional cooperation to make scalable project and think through the value chain end to end. The large private equity firms, they go for size. They simply go for size, and to set up a fund of size. Let's take Africa. To set up a pan-African fund in terms of 10 billion for SME projects, it's impossible at the moment to attract capital in that amount, because we even don't have the data. We don't have the track record, we don't have the history, and professional investors need the data to assess the risk and then start. So I think we can do both, like KfW has smaller funds in Latin America and Africa and in Asia, which we want to scale slowly. But in addition, we have large-scale project via KfW IPEX, where we strongly believe.
Great, thanks a lot, Stefan. Admasu, let me turn to you. Leading the Trade Development Bank, you are in a special place to see the flows across the corridors and to see the DFIs and the private sector coming together and working more or less successfully together. It would be great to hear from you first. I know that most of us know the Trade Development Bank, but if you can share some of the highlights that TDB is doing, that would be very useful. And we would like to have your perspective on how the DFIs, on Stefan's points, can come together, work together, and what do they have to offer?
Thank you, Amin, and good morning to everybody. The Trade and Development Bank, for those of you who may not be aware of us, we are a development finance institution, but the T stands for trade. So we're a very big trade financier. It's a good half of the business that we do. And that could be very short term, like the commercial type banks that Stefan was referring to, but it could also be ECA mixed business that has very long term tenors involved. I think the industry, I think the report that was jointly sponsored by the two colleagues on my right is a very good overview of how the industry has been evolving. And I think there's no better word than evolve as a description of what's been happening. All the DFIs were members of the IDFC, all the logos you see on the walls. I mean, even when we started as a club some 10 or so years ago, you know, climate was there, but it was never there the same way it is today. So it's just, we've been ramping up, experience has been building up, technology has moved, the resolve, of course, at the political and shareholder level has also drastically increased. So we've all been moving, and I think that's the general good news, but I think, as you were saying in your opening remarks, plus 10 per annum is not good enough. How do we get to plus 30? And I think this is where innovation becomes very important, and you know, whether it's business models or operating models, but also, you know, new instruments and new approaches. Blended finance is a very popular way now to try to move the needle, especially to attract partners in who wouldn't normally be involved. We're all doing that. in different ways. I think the one thing one can, I think, safely say is even though the climate finance numbers are woefully inadequate from the analysis that everybody is referring to at this COP28, 3 trillion, we're not even half at that level. But even though the supply side is low and people are complaining about that, the demand side is very problematic, right? And this is where Stefan is talking about, financial institutions, but it doesn't matter what kind of DFI you are, even if you do equity financing, there's limits to how much you can lead, right? So you have to work with sponsors. And I think that is also taking a lot more time than we expected because, it's very difficult for the real economy to move at the pace that sometimes the world is asking. And it's not that they shouldn't move faster, but I just think pragmatically, when you just look at what's happening, we all have facilities that are not drawn down enough because you're making the funding available, but even if you commit it, it doesn't sometimes disperse fast enough. And so I think that we need more specialized interventions, more upstream, and I think that's another very interesting area in the industry where we're beginning to see development finance institutions pulling up their sleeves and getting involved in riskier engagements, at the equity level, at the project preparation level, at the project development level. Everybody's talking about that these days. If you went back 10 years ago, everybody is like, oh, no bankable projects. I'm here. You know where to find me when you have a project that needs financing. These days, just about everybody in the industry is saying, we will accompany you in the process of origination. We will help you take some of those risks upstream. And I think this is also happening in Africa. It's very recent that African institutions, have, of course, a lot less capital. We're much more constrained than the larger DFIs that are based in bigger economies. But even us, you're seeing us all, build out these new facilities that are really pre-financing facilities, a lot more riskier. It takes bigger commitments, but it's an indication of how much we're willing to do more. I mean, if you just look at one of the largest wind farms that was done in Africa about 10 or so years ago, even back then, before it was so popular to talk about blending the way it is today, back then the sponsors didn't have enough equity. So the banks had to come in and actually agree to put quasi-equity into the project. And that was not something that was part of the original design. But we were all very, solutions orientated, and we just looked at the sponsor and we said, all right, we know you're very committed, you have track record. You need us to put more equity in. A few of us looked at each other and we said, all right, let's put some equity in. And so you already had blending going on some time back, but that was more on the risk capital side. Now we're seeing it more upstream. And I think the other problem we're having that perhaps needs more attention at COP28 is, how can you get the last mile players? People talk about, regions such as Africa or parts of Asia, low income developing countries not, having that many climate finance projects. That everybody talks about the tiny percentages. It's very, very small. It's a couple of percent of the volumes worldwide that's in Africa. And if one wants to push funding to where it's most needed, your remarks, people have to get it, that you have to just take the risk appetite issue firmly in hand and take more risk. I mean, we live in a world where everybody's so fixated on ratings. Private sector is so, most African countries these days making so much noise about how they're being squeezed out of the market, Even countries like Kenya that historically have been considered to be attractive risks, even they struggle these days, So there's a lot of paradoxes out there. I think having the global community here talking about the issues the way we've been is great, but let me be honest with you. If you were really to take the pulse of the people out there in the low-income countries, many people feel that, you know, this has yet to come to their part of the world, and that this is, you know, all the best intentions being discussed, but in the reality, you know, nobody wants to take risk, you know, and it comes down to that. So we've had a lot of opportunities to crowd in private sector from Europe, from elsewhere, by bringing in guarantees, by sharing risk, by doing risk participation agreements in ways that are not conventional. And it's helped. Like, you know, almost 1/3 of my loan portfolio has participation from the Lloyd's of London syndicates in the UK. Not many people would expect that for an African bank. So I sometimes say, well, you know, that pool of capital is participating very nicely in my portfolio, and it's across the spectrum of sectors. So I mean, we are having successes, but I mean, I'm a very rare financial institution in Africa that's investment grade. You know, you can count us maybe in one hand, and you're talking about a continent of 55 countries. Maybe Mauritius, Morocco are the only two, plus Botswana, 3 countries that are investment grade. And usually financial institutions are tightly coupled with the sovereign rating. So out of 55 countries, 52 are not investment grade. Even big global institutions like the World Bank, who we work very well with and we have a lot of respect for, they even have criteria where they can only go to a certain level, right? So they can't deal with counterparts who are single B rated, as an example, let alone the C range, and there's a lot of them in the C space too. So I mean, I think one of the pink elephant issues in the room is, you know, risk appetite. You know, where will we get to that point?
Thank you very much, and we'll go. So just a couple of points I want to. Where everywhere we see unite, act, deliver. You talked about trust. Trust starts with intentions, but it needs action and delivery to really build up. While working on this report, we looked at some reports, and just on your point on blended finance, a report which was issued in 2003, to your example on onshore. I think 90% of that report, unfortunately, is still relevant today in terms of issues, what needs to be done. And you talked about moving upstream, which, to your point, Stefan, can also maybe help on the risk of that second layer that you mentioned. You also talked about last mile, so upstream, last mile, that's why DFIs are almost everywhere. So before moving to your keynote, Stefan, on KfW and its role as a transformational promotional institution, I wanted to move quickly to the operating model from what Wendy was and 3 points I would like to have your reactions on. The talent gap, which is real, and we cannot just hire new talent because we need to also upskill the talent that we have. Would like to have your perspectives on how you've seen this evolving and how do you want to accelerate it. Talent gap, the role of digital, artificial intelligence, generative AI, how can these technologies be enablers? And last but not least, a word on the role of cultural change, because we're coming institutions, KfW is 50 years, long-standing relation and ways of thinking and ways of working. I'm sure that you're facing this challenge of cultural change. Would be happy. I know it's 3 tough topics and heavy topics, but if we can have your perspectives on that, maybe starting with you, Stefan.
Yeah, I would have been made this as a part of my keynotes because listening to you, there is a consultant inside yourself because you were mentioning the 3 key levers, IT, people, and culture. And that is important not only for us as institutions, it's equally important for Deutsche Bank or any other institutions to focus on these key levers, starting with IT. Also, we are a bank, we have a lot of legacy IT, which we need to transform. And we have decided this summer to have a 4-year project to transform the legacy IT because we can't rebuild them. But we need to start. If you don't start, the problem gets bigger. And that's why we said it's a long-term investment, but we need to start and do this. The second layer is, of course, digitalization and the application of artificial intelligence. We have started this. There is a strong commitment by the institutions that any new product will be delivered in a digital way end to end. It's not a lot, because our partners and distribution partners, for instance, in Germany, would love that our old existing products will be digitalized, but we don't have the capabilities and resources. So we said, let's focus on the future. We can't change the past. I'm joined only 2 years ago, but the commitment is clearly on the future. And the application of artificial intelligence is a massive opportunity. There's too much, we speak too much about the risk, but in our society where we have a demographic shift, there's a lot of work which we can do much more effective and much more efficient with the application of artificial intelligence, i.e., we do more work with less people, and the work will have higher quality at least in our industry. That's my belief, and that will attract immediately from IT to people. If we create a work environment which is more attractive, we will attract better talent, but also there is a war for talent across the entire workforce. And that is a concern to me. It's not only a concern in Germany, but I just come from the South African panel. It's a huge challenge for a country like South Africa, where we have a youth unemployment of 55%. How do you educate these people, right? And education, it's not only good for democracy and progress, it's also necessary in order for the green transformation. You need real workers, you need engineers, you need software people, etc., etc. This green transformation globally requires skilled workforce. And thirdly, culture. I think we as an institution have a very strong culture, but we also will have a project next year. We call it a cultural journey, because I believe while we have a great culture, we need to adapt to this changing environment by creating a culture which sees change as an opportunity. And we need this in KfW, we need this in Germany, and we need this globally. Again, we focus too much on risks. Like your example, it's the same example. We need more a change in perspective and see the opportunities in the change. And the green transition is a great opportunity for social and economic progress in many, many countries, including the global south.
Thank you very much, Stefan. Wendy, maybe to you, as Vice Chair of BCG, looking at social impact and CNS, beyond the world of financial institutions and DFIs, could you share with us how do you see these same topics developing, technology, culture, talent across industries?
Yeah, I'll bring them right back around. And what you see is a great example of cooperation up here with one mic, where we are all forced to cooperate. Let me start with where you left off earlier, Amin, which is about trust. How do we build trust? It's with a better flow of transparent information. And what some of the new digital tools are enabling us to do is get better information more broadly. Adma, you gave a great example of building wind in the early days. And I think what you said was, you know, we knew the developer, we trusted, we had the visibility. How do we create the visibility that you had being proximate to that organization much more broadly in the world to bring more sources of finance to those kinds of opportunities? I actually think the technology we have, the digitization potential we have, advanced analytics, Gen AI, it allows us to build, when used correctly, more trust to bring more types and more sources of finance into these things where historically the information that was needed just wasn't getting disseminated broadly enough. I think that, for me, is the exciting part of what technology can do to build, not erode trust. I think on the people side, I think, Stefan, I love the fact that, you know, the fluidity between private and public sector. We hear so much, you know, all these last week and a half around public-private partnership. When public and private don't understand each other, when haven't walked in each other's shoes, it's really hard to make that partnership real. And the more flow of talent we get that moves back and forth from public to private, understanding the perspective and that responsibility of the public trust, and the private sector and the ability to sometimes historically be more adaptive and innovative into the public, that fluidity of talent, I think, is incredibly important in building across what we're trying to do together with the DFI institutions. And then just lastly on people, I mean, we are all rational actors. People respond to the incentives they're given. And so when they're given incentives that are all about avoiding risk and not making a mistake and never making an investment that fails, what do we think we're going to get? How do we incent people for being willing to take a little bit more risk in the spirit of knowing that there are things that we have to accomplish and knowing the only way we're going to move the world at the pace we need to move with the financing is a willingness to take a little bit more. And so how do we create incentives for all of us to do the thing that we know we need to do, but somehow doesn't always flow through into how we all feel like we're being evaluated sometimes? Being very direct.
Thank you very much, Wendy. I would suggest that we move maybe to our second keynote today with you, Stefan, to share with us. You shared already a lot on on KfW and how it started now. You shared about the tech roadmap, the people agenda. I'm sure that the audience would love to hear more about what are the strategic steering that you're giving to your teams. Would that be for the business model, internally operating model? And would that be also for the outside, DFIs, private sectors, governments, which we haven't talked about? Happy to hear from you. Yes, please.
5 minutes, right? So very quickly, as I said at the beginning, I'm now 2 years at the helm of KfW, and as you would expect from a new CEO, you start with a new strategy. We have called it transformation agenda because I believe you can only play a role in the transformation, which is the task of in this decade and for the generation, if you transform yourself. So transforming yourself gives you strength and credibility if you want to transform jointly with others. And the strategy starts with what are the key fundamental trends. All very simple. Climate and biodiversity on the one side, and digitalization and innovation on the other side. It sounds so simple and so beautiful, but it's then so hard to execute because we believe, and we are a global climate financial institutions, we are the largest financier in biodiversity, but we really understand it. Do we understand the ecosystem? Do we understand the role which we play? And that was the task of the strategy in both fundamental trends, to define our role and understand the ecosystem. I keep myself very brief. There's a lot of work behind it, and we have many projects to do what I just said and execute. The second layer is how are we doing this? And there are 3 layers which I think is important, which also you find in the report. The first layer is clearly what we see 2 years ago, mobilization of private capital. Again, you can say not very creative and new, but it's so important. And all the reports and all the work I have seen the last 2 years have reconfirmed that this needs to be a core pillar of our strategy because the public sector alone will not be able to provide the financing needed. So we need the new form which you described of partnerships, new thinking, fluid of talent, etc. Mobilizing private equities with new products, techniques, etc. The second element is impact management. Given the resources are very scarce, we need to understand and predict the impact of what we do. And we need better data, we need technology which builds trust and pays also in on mobilization of capital, impact management. And the third pillar is collaboration, which I said I do see a paradigm shift, that there is a great partnership. IDFC is a wonderful example which was created more than 10 years ago. This represents the global world. 26 members, and jointly we can make a difference. So let's win together and let's share the knowledge and be result driven. And biodiversity is a great example where KfW is the largest financier at the moment, but we have brought this into the group, we have formed task force, and that's why we grow. In the meantime, 80 billion in biodiversity in 2022. You can argue, not enough, sure, but we have started. And it starts slowly, and then hopefully we can scale. And the third Ella after strategy, second layer, how we do this, what does it require? And it requires an operating model which is effective and efficient, like for any institution, also in the public sector. And we want to lead by example as a public sector in terms of talent, operating model, risk management capabilities, and governance. So again, very, very simple for a bank, but hard to execute. And at the moment, we have more than 100 projects within KfW against this strategy. We see a lot of progress. We see a lot of interest in transforming in institutions with more than 8,000 people operating in 80 countries. And we want to play an important role because we are relevant. And from this relevance, I think we have a special responsibility to lead by example and focus on those things which really matters. So thank you very much.
Thank you very much, Stefan, for sharing these elements with us. One of the things you said before that I liked a lot is taking into account the voice of the ecosystem. You talked about the voice of the investors, but I'm sure we can enlarge the concept to other players in your ecosystem. That's why I'm turning to you, Admaso. From what you've heard, can I ask you to be the voice of the global South also, this part of the global South? When you hear this strategy, and when you try to say how, if we had to apply a similar one in other parts of the world, what are the things that you think make sense as they are for other DFIs in that part of the world, and what are probably some specificities that you would add?
Well, you know, it's a very interesting moment in this journey to net zero. We're all really grappling with the issues, and DFIs are a very key focus in that. Not that the private sector doesn't have a big role to play, but because of our shareholding nature, because we are there as public interest type institutions. I think the global South has been trying to digest the sincerity, the credibility, and the trust. I think it's perhaps the most important word that's been said this morning, because really, I mean, you know, when you strip away the discourse, right, and the rhetoric, that's what you end up with, is whether people believe what you're saying, whether people are going to walk the distance with you, whether there's going to be fair burden sharing, right? These are the issues at the top of the mind of the global South, right? Because the constraints are so profound, and even the basics these days are not even there. If you look at the latest reports on the SDGs, you know, we're on track with just 15% of the SDGs, and that is supposed to be a mainstream development agenda, right? Of course, climate is now also mainstream, but the SDGs have been, you know, underway for much longer, right? Climate has become increasingly a very top issue today. Everybody's aligned. But even the sort of more generic development issues are underwater in a big way, right? So I mean, I think there's a lot of reality checks that are going on when one looks at where development, we talked about climate finance, and there's a lot of talk about how we can get more of it to flow where it needs to go. But if you just look at ODA these days in development financing, right, the discourse in important forums like this does not match up with reality, because the reality is everybody knows where the money's going. And the money's going to new issues that just crop up overnight, and all of a sudden you see where there's political will, billions can flow in days, in weeks, in months. But you know, we've been hammering these issues for years, and somehow you don't see the needle moving a whole lot, right? But then you see other issues coming up, and then all of a sudden, you know, you see you know, tsunamis of money going there. And so this is the trust issue, honestly. I think it is one thing that we can't come all the way to COP28 and not, you know, ask me to speak on the global South, right? I mean, I'm not a controversial person. I'm a banker. I tend to look more at metrics and pleasing my shareholders and doing all of those things. but I mean, and my partners, of course, I make sure that I don't disappoint him because he has to also deal with his stakeholders. So as the financial people, we're very disciplined, and we know at the corporate reality, you have to do your professional job. But when you look at the landscape and you look at the discourse, there's a lot of disconnects, really. And I think maybe with BCG type clear thinkers, they're legendary strategists. Maybe they can help the world be a bit more clear-eyed on how to deal with some of these disconnects, right? Because there is a big credibility issue, a real big one, and it doesn't get the attention it needs to because a lot of folks just want to be seen to be playing their part and saying the right things. We all know that political correctness is the order of the day. Well, I think there's a term these days that's become very infectious. Anne-Marie, what's that? Woke, the term woke. In social circles, it's become a very interesting term. And and sometimes it gets in the way of people being frank and pragmatic, right? So, I mean, for me, to be honest, I kind of find that there are very, very realistic partners that you can work with. I mean, it's not because he's here on the panel with me, but one of my best partners in Europe is KfW. And honestly, it's something that it's because of the culture, right? Because with culture comes understanding, with culture comes behavior, right? And we trust KfW. My colleagues are all nodding because whenever you mention the word KfW, people feel it's worth the effort. You're not going to go a long distance in engagement and then find that there were a lot of hidden issues that weren't transparent, to come back to your point of transparency. So I mean, it really matters a great deal, and I think for us as Africans, we have a very good, recent history with Europe. I think Europe is coming more and more to the party. We're seeing a lot more sincerity, big initiatives, and so it's much more hopeful today. I just think there are some who try to be holier than the Pope and make life very difficult for us. So the whole thing is greening. Greening is a verbalized word of a noun. Green is a noun, but greening is a verb. It means it's a transition, right? And so you expect basic logic to apply and people to understand that you're moving in a process. We are working very well with the World Bank Group these days, and they followed in the good example of KfW. They were not always our big partners. Today they're very big partners. Maybe you help show the way, Stefan, you and team. And it's great to see the World Bank, coming to us and saying, we know you're a big institution, the transition is the reality, but here's what we can do. We can work with you on building special purpose vehicles to address green housing, to address green transport, electric mobility. You put in 5%, we'll put in 95% of the funding. You're close to the ground, you have visibility, Let's get away from this old mentality where if you're not coming from a AAA background, you're not relevant, right? So now the big players are all really coming into the party and saying, in this last mile environment, you guys may not be big, but you're relevant. Yeah. And we need to work with you to put wind underneath your wings so that we can, get that momentum. So I think there's very bright spots out there, but there are still occasions where we have to push back. We have some folks who just say to us, it's almost like there's no transition, and they say, we want you to be green overnight. And I'm like, if you have a magic wand, lend it to me, and I'll become green overnight. But nobody has a magic wand. So sometimes there's that lack of sincerity where you kind of find that people are being too hard on you, and then you're saying, well, I'm the smallest part of the global problem. Why are you being so hard on me? Maybe you should be a bit more fair.
Thanks a lot, Masu. Very well said. And it's amazing to see that it all comes down to scale and speed, even on trust, because you gave a great example of a relationship where trust exists, and what we need is to have it enlarged to all institutions very quickly. Stefan wanted you to come back on one topic, because you talked about biodiversity, and with just my hat as working with financial institutions globally, I must confess that in the private sector, and don't get me wrong, some of the banks are trying to go into that space and to do, but the majority is still pondering how to deal first with climate, so let alone biodiversity. How do we measure it? We don't even have scenarios, etc. It would be interesting if you could double down on that and tell us what made you and KfW take that decision and go for it at this scale ahead of everybody.
Yeah, a lot of people say biodiversity is the sister or the brother of climate, or the other side of the coin. In different words, you need to think climate and biodiversity together. If you look at the data, without biodiversity, the CO2 budget, we would have crossed, I think, in the 80s already, the climate change, right? So biodiversity is paying massively on CO2 reduction in a big way. And it's the issue with biodiversity is its complexity. It's multi-dimensions. According to the Potsdam Institute, it has 9 dimensions, biodiversity, and that makes it so difficult. To translate this into KPIs or into investment behavior is very, very tough. We are working hard to do this. Given our new strategy, we are working on a biodiversity roadmap, which once finished, we will definitely share and encourage people to think in any investment process the biodiversity implications. And that's equally important. If we win the climate race but lose the biodiversity race, we are gone, right? And that is something which we can't repair. I don't want to go into any details. And it's not about just investing into a forest or into the Amazon. It goes much beyond the things which are in the public domain. And it scares people equally as climate change. And if people are scared, the normal reaction is you don't want to hear about it. The psychological reaction is very difficult. So we need a positive narrative why biodiversity is a great game changer for us on this planet to save this planet. It's just, unfortunately, that's unfortunately the truth. Yeah.
Thank you very much. Second time you're talking about opportunity, we can also see that you have a soul of a banker, even private banker. And I love a lot this mindset, because opportunity is a positive narrative that gets people moving much more than risk, which also is on the table. One question to you, Wendy, before we move to your keynote, and Masu, around, because when Stefan was talking about his 2 key priorities, I was thinking about the 2 moonshots of BCG, which are climate and sustainability on one side, and digital and artificial intelligence. You're part of the leadership of the firm. Can you tell us more about how a different kind of institution is looking at these 2 topics?
Well, I'll be very brief because I know we're all trying to run to the next thing. But in terms of BCG, Amin mentioned we're focused very heavily on AI and climate. But as we've talked a lot about many of the topics today, the intersection is incredibly important. And so where I actually spend a lot of my time is, how does AI come in to accelerate climate? How does climate come in to actually be the best use cases we can for the development of AI? So we've launched something called AI for the Planet in partnership with the UN. It's how do we actually bring all of those AI startups into scaling to make a difference on climate? So I would just encourage us all, in the spirit of brevity at this point, is how do we push the intersections between all of the topics that we're talking about today in a way that enables us to trust, to see, and to do more faster.
Thank you very much, Wendy. So I propose that we move to our 3rd keynote with you at Masu. Let's take 5 minutes, if you agree, and then we'll open up. I know that all of you have many questions. We'll make sure that we have 20 minutes to take some of your questions and try to answer them as good as we can.
Always helps to stand up and get the blood to circulate. Very quickly, I think this exceptional report that we have been discussing also really reflects in many ways the pattern of our journey as TDB Group, where we started to see these imperatives building up. We've all had ESG in our strategic spaces for quite some time, but it's been building up. And the question, I think, around business models and operating models is to what extent have you now mainstreamed it and scaled it up within your space and giving it? And we actually had a very interesting experience when the first SDG conference took place. I think it was around 2015. And if those of you who know the global goals, there was something called MDGs before the SDGs. And when the SDGs came along, climate became quite important in the mix of goals. That's the first time we started to really change our business model and our operating model to introduce targets and to incentivize and to do all those things that you do in a sort of institutional framework space to get the rhetoric to become reality, right? So you start doing all of the rewiring internally, hard and soft. And of course now it's a second iteration, because after the Paris Agreement we realized the SDGs did put emphasis on these issues, but not enough, right? And so now we're all talking about deeper alignment and bolder action and all of that. So one of the things we've done is we've said, well, we are at roughly $9 billion asset financial institution. We can't change our portfolio overnight, but we're going to introduce something called green shares. And everybody is very familiar with green bonds because it's very topical. Green shares is not as topical. It's been out there for a while too. And we've been really trying to sort of rise up to the occasion by saying, we're going to start attracting a very specific type of capital that's going to now dedicate itself to climate and green finance, and we're going to do it in a way where we can guarantee that multiplier effect, because we all know that that's the nature of equity. When Stefan talks about 40 billion of equity and a balance sheet of 600 billion, you understand the power of leverage. And that's what we tell investors. We tell investors, you put in $10 million of green shares, we will guarantee $30 to $40 million of green assets on the back of that. And we've now rolled it out, and we had our first announcement of a first investor that came in at Sharm el-Sheikh at the Africa COP in Egypt last year, and now we're rolling it out. And some of the very good investors who are not very profit-minded like the profit because it's a signal of health, but then at the same time they've said, instead of paying us dividends on these shares, we want you to create a special facility, put that into that facility and go upstream and do the heavy lifting. And we're going to give you very, fit for purpose funding where you can actually go help the developers, help the real people on the ground who struggle to put these projects together and make them feasible. And I think this is something we're looking to scale up. And now the new area we're going into beyond Green Plus shares. And the reason we call it Green Plus is because we said that the good should not be the enemy of the best. So we said sustainability and climate alignment are cousins, and one should not exclude the other, right? So that's why we say Green Plus shares, meaning if there's SDG type transactions, we can also do bits and pieces with that. But anyhow, just now we're looking at hybrid capital. That's a new, very topical area in our industry. For those of you who follow our industry, it's happening at the global MDB level. It's going to happen at all the other DFI levels as well. And we are very actively now engaged with a number of partners to see how we can bring in that hybrid capital and use that also to advance some of the greening of the capital within the institution. Not that it should, choke out all the other things that you still need to do as part of a transition, but you do it in a way where you give your new partners that dedicated impact that they want to see. And it's something that they can report back to their shareholders and build that confidence that these COPs mean something, right? There's new capital coming in, it's having multiplier effects. And some of the foundations these days are also coming in and doing much more upstream, which is where we have to move up in our industry because it's a very uncomfortable place to be. And this is the problem with our industry is, you know, we happen to be fortunate because we're the ones holding the treasury chests. And anybody who wants it needs to knock on our doors, and we're the ones who say yay or nay. It's different for the others who are trying to always rise up to your approbation, and they have to actually put things together and make it work. And it's very hard to make things work on the ground, right? And I think this is where we are increasingly going also as TDB, is to say, let's not sit too comfortably in our treasury chest position and tell people, no, you don't cut it, come back, go do more homework. You know, try to be a little bit more part of the solution where you reach out and take a little bit of risk. You know, there's a lot of interesting instruments that have come up in the industry over the years. Stefan talked about blending. There's a number of ways to blend. He talked about the first loss pieces, which have been quite reasonably effective, but there's many other ways of blending as well with the private sector. And we're finding ways and means of doing that. And just maybe a final note for you on TDB. Some of you may know that there's a lot of noise out there about crowding in this trillions. Everybody remembers the billions to trillions, you know, mantra that came out with the sustainability goals. And we decided very specifically to go and knock on institutional investor doors and ask them to join the party. And it wasn't easy, because institutional investors would be happy to join Deutsche Bank because they know Deutsche Bank is a much more reliable investee company to generate dividends and be more commercial in its nature, because that's how a private institution should be. As a DFI, it's not easy to attract institutional capital in the same way. But we managed to convince one, and then one became two. Today we have over 20 institutional investors in our capital. We adjusted our capital structure. We introduced new segments. We introduced tier 2 capital, which is not something that is common within the DFI world. You'll find it more in the Deutsche Banks of this world, but we are also trying to learn from the commercial banks who do a pretty good job at structuring capital. They're very innovative in that regard. And so we've been doing that quite a bit. And we're looking forward to work with partners such as KfW and the other IDFC members around, you know, taking bigger positions on the risk capital front, maybe on the hybrid side. That's the hottest area right now in our industry, for those of you who are interested. There's been some announcements at this COP. We expect even more announcements in the years to come. Even the heavy MDBs, the World Bank, the African Development Bank, they're all moving into hybrid capital out of the G20 recommendations. And hopefully in 2024, we'll announce our first hybrid capital. So yeah, I hope to share more with you in due course. Thank you.
So we have some time left. We can take some questions from the audience, if any.
Joining the cooperation with you and just taking the same mic again. Yeah, my name is Sebastian Berners. I couldn't echo the comments where I used to start as a consultant with Booz Allen. I worked operationally, sold the company. I now run an NGO in Ethiopia working with smallholder farmers in the rural area. So I personally experienced a complete misunderstanding between Euro and Africa still, and the lack of risk-taking on the European side of actually investing in Africa. But recently I've been thinking, isn't the contradiction in terms that we have bankers talking about climate, where climate or nature is not even an asset yet? It's a bankable asset. So can we actually expect to change anything more until nature becomes the bankable assets on the balance sheet? Isn't that the game-changing element? So where are we on that? Because that's going to turn Africa into an absolute rich country in terms of collateral once you start measuring the ecosystem's value as a capital. And of course, this is a question for regulators, more for auditors to actually design the concept. I mean, with CO2 carbon pricing that has started, but we see the difficulties of actually putting a price into there. But wouldn't that be something bankers should promote to turn this narrative much more to actually more investable assets in Africa or elsewhere?
Thank you very much. It can even become a rich continent, not just country. Stefan, do you want to take this question?
Thanks. No, I would answer it in the following way. I think, unfortunately, the world community is not prepared yet to move to a CO2 pricing model or to biodiversity credit model. At the end of the day, behind your question, I understand how can you monetize and price the external positive and negative effects. And that would mean, for instance, if you have biodiversity credits for the global south or many African countries, you would have a wonderful source of refinancing. We as KfW are promoting both CO2 pricing, and I think Germany is a leading voice in Europe as well, and also our current government with the climate fund, which I think is great, but we are not yet there if large countries are not willing to commit. And also, Europe is not moving the CO2 pricing massively upwards. And you know all the numbers, right? We would need to go to 150 ton probably to have the market solving with the problem. In terms of biodiversity, we have created with the German government the Legacy Landscape Fund. You may have heard about it, where we have more than 200 million government money, and we are currently in debate with large institutional investors to provide money and also think about private biodiversity credits. And there is an interest also from large American firms, for instance, to start and support this project. So we are moving ahead. I think it's fantastic. It would solve a lot of problems if we would have what you have in mind. I can't say whether we will move there in 10 years, in 20 years, or we will move there everywhere. From a game theory perspective, it's very, very hard to solve.
Just one small add, it's very early days, but the encouraging sign I see is in recent days with the launch of the TNSD, which was creating more transparency and disclosure around the nature-related dimensions with the creation of the science-based targets for nature, right? Not just the SBTI for climate. I think what we're starting to see are some of those institutions building post what we saw with the Montreal Kunming and the commitments that were made there. So not nearly the state of maturity that we have with climate, but I think the creation of those institutions and those commitments are the starting point for being able to move towards more of what you're talking about, Stefan.
Let's take two questions. You have the mic, and then we'll hear from Deutsche Bank.
Thank you very much. My name is Eugene Itwa. I'm the CEO of Natural Eco Capital. And good enough, you've taken one of the things I wanted to say, for the fact that the rich resources we have on the African continent, and indeed everyone is scrapping to come to the African region now, I think should be the foundation for sustainable investment for us. But in addition to that, you talked about impact measurements, you talked about better management, you talked about voice of ecosystem. And how do we evaluate? In a number of your statement, you asked how. It came out astoundingly. And I was just thinking that one of the ways I guess we can rein in everything is using, because you also talked about the SDG as well. I think we have the SDG IPA standard that are voluntary internal management standard that can be used in harnessing or embedding sustainability and indeed the SDGs into decision making. And I think using this tool or framework will support all of us in embedding all these things, beautiful statement we've all made. I'm a trainer in that regard for UNDP, SDG IPA standard. We can all Google it and check what it's all about, and you see that it will actually support us in that internal decision making. And coming out well to get all these things well embellished in what we are doing. So let's look at it and see how indeed we can enrich our internal processes with a view to supporting the external world. Thank you.
Thank you very much.
Yeah, thank you. I'm Jörg Eigendorf, the CSO of Deutsche Bank. I think your question was just great because it is, and I'm a little bit more optimistic after the last couple of days. And I want to connect it also with a question to Ed Masso Tadisi. But I think, and maybe that sounds unusual from somebody from Deutsche Bank, but I think we've seen market failure here for the last 50 years in not being able to integrate the externalities into our pricing system. And we don't have 10 more years to go. And if it's a way to, we personally, we as a bank think that nature-based solutions could be a way for a lot of the struggling countries. You mentioned them, 52 or 55 countries are below investment grade. That is a way, with the support of the international financial institution, financing institutions, with the support of the private banks, with the support of investors, with the support of the insurance companies, with the support of the NGOs, and that already shows how differently we have to think. But that my question is now, how are we going to tackle two issues? First issue is the governance issue we often face, because you are investing into countries which may have a governance issue. And the second issue is, how do we tackle the point that we really need the communities on the ground to benefit from these financing, and that it is not siphoned off away among, the first who really make money from nature-based solutions are the lawyers. Before we have made any money, the lawyers are rich. And how do we get, and until the money is where it should be, we see so many things taken away. And how are we going to tackle this issue more effectively? I just have to say, after my COP here, I'm much more optimistic. We have leapfrogged. I think there's a new asset class arising, but I think it needs a lot of thinking how we can work together better. But we need to tackle these two issues, the governance issue and where does the money end?
Well, you left the hardest questions till the end. Governance is a big question. I think it's a gray area, clearly, because there's been a lot of mobilization to improve governance, and there has been successes, but the truth is it's still a journey. And I think the best way perhaps to deal with it is to reward and create examples, and in that way the incentivization mechanism kicks in, and those who are sitting on the fence see this and they say, well, maybe it pays to deal with governance. And so there's a number of African countries that have been very successful with governance. I was just in Botswana yesterday. I arrived also at 4 a.m. this morning. One country that's also done quite well, Mauritius, countries like Rwanda, pushing discipline very hard and trying to deal with this whole question of coherence around the system to make sure things actually get through to the final beneficiary. It's not easy, because I think sometimes the philosophers on governance don't realize that there's something called capture, right? Value capture. And I think the private consultants often talk about capturing value, right? And I find that, you really need strong leadership to be able to ensure that that value doesn't get captured down the route. And that sometimes, it's not very popular these days to be a disciplinarian, right? In a liberal world, if you're a disciplinarian, you're a bad person, right? But that's the only way sometimes to ensure that the system is coherent and you don't get this hijacking that happens along the way. That's really the governance story, right? You say all the right things, you kick it off, and then it gets diverted in all sorts of ways. And if you don't have somebody who's, playing that inconvenient role of being a bit tough, it'll be a free-for-all, right? And that's the problem sometimes with, I think, the South. Sometimes when they look at the debates around governance, they say, well, maybe we need strong leadership to help ensure that things can happen a little bit. If you keep it too loose and too soft, then it's going to go sideways, as it often does. I think the best thing one can do from a pragmatic perspective is just reward those who are doing the right things, and then at least you realize that it creates hopefully a vortex where more and more will start adopting that right behavior. We've actually been beneficiaries of that. We've received billions and billions of dollars of financing over the years because we really paid attention to our governance. We did a lot of things that were not easy to do, but we did it. We got our shareholders and our stakeholders to back off a little bit so that there can be autonomous good governance at the institutional level, so you don't have too much political pressure coming from far where you start, doing things that are not, considered to be, wise at a governance level. So I think that's the only thing one can do. But maybe for another conversation another day.
Thank you. Wendy, maybe? Thank you, Masud.
I would just add very briefly, we've talked a lot about technology and how the cutting edge of technology is our friend in this. I think what we are seeing in terms of platforms that are able to provide the visibility and the assurance about where the benefits and the value are being shared, specifically with the farmers and the fair wages as things come through the value chains, I think is a tremendous innovation that's going to help with the right governance in place, some visibility and some strengthening of the shared value.
Thank you very much. We're at the end of our great discussion. I'm sure that we all have great takeaways. I'm personally taking away 3 things. The trust notion, it exists here and there, but it needs some massive scaling and it needs to be accelerated. I liked a lot the transform yourself before to be credible and transform the others. And it's great to see the larger DFI walking the talk and doing it. And my third takeaway from you, Wendy, is keeping ourselves honest and looking at the nitty-gritty, looking at reports, the incentives, the metrics that we're putting on our heads. They need also to be aligned with this ambition. So for all these takeaways, a huge thank you to our 3 panelists. It was very insightful. Thank you very much. And please have a look at the report.
What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities, In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the coming Montreal Global Biodiversity Framework. Our goals: knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between
Welcome to today's side event at the IDFC Pavilion, and that includes you here in the room and also everyone online. My name is Barbara Schnell and I'm from KfW Development Bank, and I have the honor and pleasure to moderate this wonderful session. So today we will be jointly working on the question financing green hydrogen and its derivatives. What has been achieved thus far? So for the next about 75 minutes, we will gain insights from public as well as private sector. We will hear about relevant investment activities from a commercial bank as well as a bilateral development bank. And finally, we will explore the relevance of Power-to-X for a green energy transition and the transformation of industries. So first of all, why do we come together today and discuss about green hydrogen? Climate change is one of the key challenges of our time, and investing in sustainable technologies is our responsibility. The focus is often on how to cut emissions, especially CO2. But what about the sectors where emissions are difficult to avoid? These so-called hard-to-abate industries, like steel. They form a large part of our global emissions, and reducing them is the key to a greener future. However, emissions from industrial processes increased in 2021, more than reversing the pandemic-related decline from the year before. If we continue along this path, we will not be able to contain global warming at 1.5 degrees Celsius. So how do we tackle hard-to-abate industries and address the necessary long-term structural changes? The short answer is, it's not easy. One of the more in-depth discussed solutions within the last couple of years is green hydrogen and its derivatives, like ammonia. So green hydrogen can play a key role in decarbonizing industries and enable their sustainable transformation. Only with a sufficient supply of green hydrogen will we be able to leave the fossil age behind us. Nevertheless, over 95% of the current hydrogen production is fossil fuel based due to, for example, the existing viability gap between green and gray hydrogen. So this gives reason to discuss the opportunities of investing in green Power-to-X projects and how to overcome the existing challenges. Due to existing uncertainties in setting up a global hydrogen market, a joint mobilization from public and private actors is absolutely necessary to overcome challenges. Therefore, I would like to welcome our impressive panelists for today's discussion on financing green hydrogen and Power-to-X. And I am sure that it will be extremely insightful to learn from their vast experience today. So let me introduce the panelists of today. And I start with Mr. Karim Lotfi Senaji. He is the CFO of Office Chérifien des Phosphates, OCP SA from Morocco. And he started his career at OCP as a director in charge of management control before holding the position of Vice President Shipment and Logistics. And prior to OCP, Karim held several management positions with several Moroccan and international companies such as Holcim Group, Altadis Morocco, and Medi Telecom. Yeah, welcome, Karim. Then I continue with Christiane Leibach. Christiane Leibach is a board member of KfW Banking Group and responsible for our commercial bank, KfW IPEX Bank and Development Bank, and our daughter company Deutsche Entwicklungsgesellschaft, which takes care of promoting private equity in partner countries. So it's all of our international business. So Christiane Leibach is a financial expert with a far-reaching international network and many years of experience in development finance, as well as commercial export and project finance. So welcome, Christiane. And then I continue with Andrew Johnston. Andrew is one of the co-founders of Climate Fund Managers. That's a fund from the Netherlands. And prior to Climate Fund Managers, Andrew was the CEO of African Infrastructure Investment Managers, a joint venture of infrastructure investors Macquarie's and Old Mutual, and he was the chairman of Macquarie Africa. Andrew is an experienced professional in the African infrastructure sector and has been involved in the structuring, raising, and deployment of 5 unlisted infrastructure fund vehicles in Africa prior to CFM. So he has a lot of experience to bring to the table. And then we have Mrs. Lavinia Bauer-Ochse. Lavinia is a member of the Corporate Bank Executive Committee at Deutsche Bank. She joined Deutsche Bank more than 20 years ago, and now she's the head of the Environment, Social, Corporate Governance department, and she leads all the sustainability efforts in Deutsche's corporate bank. So, welcome, Lavinia. So, how will this panel take place? We will first hear a statement from all of our panelists introducing us to their involvement on Power-to-X green hydrogen. And we will be starting with Karim, then followed by Christiane, Andrew, and Lavinia. And afterwards, I will engage in a discussion. I have prepared a few questions. There might be some from the audience. You know all how it usually works, and we will take it from there. So I would like to hand over to Karim to start with his statement.
Okay, thank you. First of all, as I said, I'm glad to be here today and thank you for the invitation. I will probably start with a few words about OCP for those who maybe are not familiar with. So OCP is a global leader in the fertilizer industry. Actually, we are the world's largest exporter of all forms of phosphate, and we focus on maximizing the soil health as well as the farmer productivity by producing customized phosphate-based fertilizer that are sustainably mined, proceed, and apply. So that is on a nutshell who OCP. We have an average turnover, yearly average turnover around $10 billion, and we are almost 20,000 people, mainly based in Morocco. In terms of strategy and vision, I mean, our purpose is to bring phosphorus to life, and that could be done through different channels. But more importantly here, I would like to talk about our strategic goals. So we have 2 main strategic goals that are very linked to the United Nations SDGs, which are fighting the hunger, so the zero hunger or the food security, and climate change. And most of the time, those 2 SDGs are opposite, because we all know that by 2050 we will be almost 10 billion people, so we have to increase the grain and the food production in the world. And in the other side, so far, the agriculture represents 25% of the CO2 emissions. And this is why those 2 elements are most of the time contradictory, but at OCP, and we have been also working hardly with some international specialists, we think that we can make those two goals going the same direction and through the what we call the carbon farming. Actually, by using and applying the good agricultural practices, we can sequestrate carbon in the soil. And this is what we want to achieve here, is that to make sure that we will be teaching and talking to all farmers in the world, and especially we have started in Africa, in order to make them able to sequestrate more carbon in the soil. So beside the revenues that they can do with farming, they will also have additional revenues with carbon farming, because this is something that we can also monetize. And from, so that's mainly to fix the climate change. And from the food security part, of course, here our role is to make sure that the farmers will have access to what we call the 4 Rs, at the right fertilizer, right time, right rate, and right price. And in order to do so, we are having now an investment program that is a $15 billion investment program, making sure that by 2027 we will be able to produce enough fertilizer that will, of course, follow the demand. But more importantly, sustainability is at the core or the heart of our strategy, and we are committed to reach the zero net carbon emission on Scope 1 and 2 by 2030, and on Scope 3 by 2040. And we already start. We have some, let's say, step goals, let's say, because in 2026, we committed that 100% of our energy use will be renewable energy. Today, we have 70% of that energy that is already renewable. And also at the same period, we want that 100% of the water we consume that will come from unconventional source water, so mainly desalination, as well as wastewater. But we are investing heavily in new capacities in order to be able to produce by 2026 500 million cubic meters of desal. And in terms of energy, we want also to be able to produce 2 gigawatts of solar and wind energy. Beside that, we have also, and this is the link with the discussion of today, we are also committed to be able to produce 1 million tons of green ammonia by 2027, and by 2032 to reach 3 million tons. And why we are doing so? Because first of all, as I mentioned, it's part of our sustainable development program, but it's also a way to be able to be net zero carbon on the 3 scopes. You need to know that we are the largest consumer of ammonia in the world. So we consume roughly 2 million tons a year. And this is something that is putting us in a very specific situation, because we need to secure the ammonia supply, but at the same time, we don't have any assets in the gray ammonia. So going to the green ammonia, that will allow us, first of all, to have a kind of, to secure the supply, but also to have access to ammonia that will be, and we believe, that will be more competitive than the gray ammonia of today. So we have announced this 1 million ton of gray ammonia production by 2027. That will require, of course, mainly based on renewable energy, so solar and wind. We are very fortunate in Morocco, because Morocco is one of the top 3 places in the world when you have perfect combination between solar and wind. And the beauty of it is that the wind kicks on during the night. So in terms of intermittency, that helps a lot as well. But of course, for doing that, we need finance. Finance will be very important. We are aiming to reach a very competitive costs of hydrogen. We are targeting $1.5 per kilogram by 2032. And in this context, of course, technology will play a key role, but the cost of financing as well. So maybe we will have a chance to exchange around that. I will stop here and let my co-panelists take the floor.
Thank you, Karim. That's a very, very impressive climate strategy you have in a very, very difficult sector. And I pay a lot of respect for that. And we will dig into the challenges you're facing, the sequence you're choosing, and why that is later on in the discussion. So may I now hand over to you, Christiane, and let us know what green hydrogen, Power-to-X, and climate finance, how that all fits together at KfW.
Yeah, thank you very much. I think probably a lot of people are familiar with KfW as one of the largest bilateral development banks. But still allow me a couple of words on how many angles we work on domestically and internationally, because I think that is, for example, very important when it comes to green hydrogen. So KfW Development Bank is working with developing countries from government to government programs in a lot of more than 120 countries. We have our DEG subsidiary already mentioned, which works with the local sector, the private sector in more than 80 countries. And we have KfW IPEX Bank as our commercial banking unit, which works with industries around the world and in Germany in terms of international trade and international investments. The reason why I'm saying that, I think it puts us in a quite unique position to understand from different angles what is moving the world today, which is on the one side transformation, obviously, and how in particular transformation of industry can happen and what is needed. And I think green hydrogen shows us very clearly this is a new, very new system, I would like to call it, which needs to be set up. It's infrastructure, it's regulation, it's markets that need to be developed, it's transport that needs to be developed, maybe pipelines that needs to be developed. It needs international cooperation agreements in terms of getting access and trading green hydrogen, for example. And so I think it's a pretty new world we are moving in there, a challenging one, and I think we have been doing only the first steps by now. But still we are very much convinced that it will be one of the decisive factors when it comes to decarbonizing the industry worldwide. Yeah. And having said that, we're trying to combine all this knowledge, all these insights we have from different angles. For example, and by setting up, and we have been doing that last year, so-called PTX platform, which we're trying to create and unite all different means and of partners and financings, the government side, the private side, international side, and domestic side. And maybe we elaborate on that a little later, but I think besides all these different stakeholders which are involved in that part, I think what it really and clearly needs when we're moving in such a new world, which is a really major structural change, is some very smart combination of public money and private finance. I think it needs both, and it's one of our ambitious targets to play a role in that, to combine these two instruments.
Yeah, we'll be keen to hear more on the Power-to-X platform as a financing instrument KfW has been facilitated to set up. But before getting into that, Andrew, would you want to share with us what your fund is doing in that particular sector?
Absolutely. Thank you very much. And Christina, thank you. It was a great setup because I'm going to pick up exactly where you left off. Because Climate Fund Managers has been around for the last 8 years. It in and of itself is an innovative organization, being a joint venture between a development bank, FMO, from the Netherlands, and a commercial financial institution called Sanlam from South Africa, who are Africa's largest non-banking financial institution. So right at its essence, it is sort of a hybrid organization. And its purpose was to actually explore and exploit the evolving technology that subsequently was called blended finance. So we are a blended finance house. What we do is we structure blended finance vehicles. We put them out for consideration to a wide range of investor types. They range from donors through DFIs, through philanthropy, through guarantors, and to the commercial sector. We package this capital into structured vehicles, and anticipating that these vehicles, blended finance, would endure and expand, we set out at the outset to, if we could get the model right, to direct it tactically into core climate sectors, starting with renewable energy in the first instance, then going into water. At that stage, we're going to do agriculture as 3, we're going to do oceans as 4, and cities as 5. This was 8 years ago. Since then, the plans changed somewhat. We didn't even know about hydrogen back then. So we've done now renewable energy, we've done water, which we combined with oceans. So we have water and oceans and sanitation being the second strategy. Our third strategy is hydrogen, which I'll talk to a little bit later on, and then we'll go to cities. It's an experiment in blended finance, and it's working really well. We've raised $2 billion across those 2 strategies over this period of time. We spent 75 of that developing 45 projects. We work really at the early stage. We develop greenfield projects and we finance them into construction and through into operations, and then we exit them and recycle that capital and repeat and rinse. So the success of the model is really how many projects can we build within a finite period of time. 45 currently being developed at the cost of 75 million. Of those 45, we put 12 into construction and are now operating. That's cost us about $700 million of our own capital, of which we've then mobilized another 500 along the way. And strategy 1 is now fully deployed, the renewable energy fund. We partway through water, and we are in the process of establishing quite creative and innovative hydrogen funds dedicated on a regional basis, but I'll give greater detail on that in due course. Oh, there you go.
Oh, no, we need
We have to be very cooperative over here, but we are managing well. Yeah, Lavinia, so why don't you finish up our round of key statements introducing us to Deutsche Bank's activities in the sector?
Very happy to, and thank you very much for having me on the panel. I'm very much looking forward to our conversation, so thank you to KfW. My name is Lavinia Bauer-Ochse. I'm from Deutsche Bank, and Deutsche Bank is the largest commercial bank in Germany. I'm specifically looking after ESG for our corporate clients, for Corporate Bank. And we are covering globally, in total, almost 1 million customers in Corporate Bank. Of course, that's not all the large corp segment. We have a very, very strong foothold in the German Mittelstand and also with the smaller SME clients in Germany. And we are very, very focused and dedicated to the subject of sustainable finance. Our client base is really, it's relevant to our client base, and therefore it's relevant to us. We've committed overall to facilitate a total of 500 billion euros on an aggregate basis until 2025 in sustainable finance. And the energy transition technologies, and hydrogen being one of them, form a major part of that. We do have a very strong proposition in project finance. We have a history of renewable finance projects we were part of, and hydrogen is really for the hard-to-abate industries and our clients which are in those industries a key lever to decarbonization. Maybe just quickly of our advances, we are very proud we issued this year, the first time in October, our transition plan. So our transition plan from a financial services point of view, bringing together how we are operationalizing, actually how to decarbonize our corporate loan portfolio, setting ourselves quite ambitious target for reductions of the financed emissions until 2030 in 7 key high-emitting industries. And finding with our clients together ways of how to help them to decarbonize will in the end also help us to achieve our goal to achieve those interim targets. We are one of the founding members of the Net Zero Banking Alliance and very active also in G-Funds. And therefore, We are very actively in those conversations and are looking for projects to be a part of. And maybe to take one statement up front, I've been to the last COPs, and I have to say I'm very happy that those conversations are getting way more tangible. We've seen a lot of regulatory framework coming closer, which is helping us all defining what are we meaning by renewable hydrogen, for example, having more clarity around the gas pipelines, for example, which will all help us to get bankability into the projects we are seeking. So I'm very much looking forward to our conversation.
Well, thank you very much, Lavinia. So let me just ask a couple of questions in order to dig a bit deeper into this green hydrogen component of your climate strategies. Starting with you, Karim. You hold a 31% market share of the world's phosphate market, and you're such a large producer of fertilizers, and you have a climate strategy. Really, you pointed out the various aspects of it, including the farmers, then including the renewable energy production, and then you said that by 2027 you want to generate as much green ammonia. So why is that last piece, which is relevant for our discussion, why is that so important in your overall climate strategy, and how will you approach it? Because your climate strategy as one of these hard-to-abate industries is really such a complex transformational effort for your organization. Just let us look into that a bit.
Yeah, I mean, that's working. For us, it's important because, as I mentioned earlier, sustainability is at the core of our strategy and our purpose. This is from one side. But also what is very specific to us, actually, when it comes to sustainability, most of the time we have overcost. Most of the time we are no more as efficient as we could have been using fossil fuels or using other sources of energy. But in our case, it will be different, actually. By using now solar energy, wind energy, that will cost us less compared to the energy we are using today that is mainly based on fossil fuels. That's one thing. The other thing is, even in terms of hydrogen itself, this is very cyclical business related to the gas, and we have seen with the recent evolution with the conflict in Russia and Ukraine, the impact that conflict has and had on the prices of gas and ammonia. So by securing our own source of ammonia and making it very cost competitive, that will also help us in our strategy, because among our strategy, the cost leadership is key. When we are in a commodity business, and being able to be the less or the cheapest producer of fertilizer in terms of cost, that is also very important. So the green ammonia approach is, first of all, in terms of sustainability, then in terms of cost, and also in terms of securing the supply and being able to supply our worldwide customers.
Well, thank you. That sheds some light on as to that for your organization. You think the business case is very clear, no? Also because of the advantages Morocco has in the production of renewables, which is so important for the derivatives we're talking about.
Exactly.
So,
and if you allow me maybe something, because here it's more about our core business today. But when it comes to green hydrogen or green ammonia, Morocco is also well placed towards the European market, and this is also a huge opportunity. So if we manage to be able to find the right technology, because all the elements of this technology are known today. You have the electrolyzers, you have the Haber-Bosch process, but the issue here is to scale up and to be able to produce at very high scale. So and being able to do so, investing in R&D and making sure that we will be able to do it first for us, but then we also could enter a new business, which is the green hydrogen and the green ammonia business. And in front of it, and especially in Germany, by the way, that is very keen to have a source of supply of green hydrogen and green ammonia. That could be also an upside of what we are doing now.
Yeah. So you can actually combine business cases, your today's core business, and then you have a vision for another business case in the future. So Christiane, when you hear that from one of our clients, so how does that resonate with you? Where does KfW stand with its relevant projects today? And what is KfW's goal in the medium term? No? What do we want to accomplish with our clients?
Yeah, very, very great what Karim just said, because I mean, we have been working on the green hydrogen initiatives now for maybe 2-3 years, something like that. And we started on a kind of single project basis, having a pilot here and there. For example, in Morocco is one of those with some government money really to start to learn, or with our partners that they are able to learn how to best set that up. We have come and seen some first commercial financings, which are very rare still, if in particular when it comes to large facilities. But you probably all have heard about the NEOM project in Saudi Arabia, where KfW IPEX Bank is involved. And we have set up other programs and discussed with governments on really developing policies and programs there. But as I said earlier, we came pretty quickly to the conclusion that it needs different instruments from private money, from government money, for the different stakeholder groups. And so we decided to set up this so-called PTX platform to be able to serve our partners, government partners, clients in the future in kind of a one-stop shop concept. Yeah, on the one side, providing funds really, for example, for pilots, for research, for development, for first small projects. But then, as we, I think, all need, government money can only set an incentive there. It cannot be more than that. And it needs to be structured in a way that it de-risks on the one side the first projects where we all, or a lot of our partners, need to learn from it. And on the other side, to set an incentive to attract more and more private capital and make business cases valid. And this is in the idea of this platform, that we combine or offer, let's put it better that way, offer on the one side grant elements, government funds, and on the other side move more and more into the private hemisphere and the private sector. And I think that is very important hopefully for our partners. We felt it is a good idea to really learn step by step together what it's need. And I mean, OCP is a very, very large and very economically very profound company. But there might be smaller ones which need even more help. You have a lot of you are very professional. You know about all these techniques. But when it comes to a lot of other countries, developing countries, they might need a bit more help in terms of financing and in terms of technologies. And to combine that is one of our targets, to be that they are able to serve their own markets, and in the perspective to serve the export markets. And honestly, we feel still that we have a very good basic idea, but we wanted to create that more as a, let's say, learning experience as well, because I think we need to all together develop how much grants are needed, what is needed in terms of equity financing, what is needed in terms of loan financing and guarantees in de-risking projects. So the platform is created the way that we can offer all that, but it's not clearly set for a good reason, because we think we need to be flexible and understand what is needed at a certain point of time when the market is developing over the years to come.
Yeah, you rightfully pointed out that we are at a stage where we are helping to pilot, we are helping to start activities, get them started. There are countries where the framework conditions are great, like in Morocco. There are other actors who are trying out certain approaches, but this is not the ramp up. The ramp up will have to happen in the future. And Andrew, that's my question to you. CFM is investing in renewable energies in emerging and developing economies, you've explained to us, and you are going to be involved in the development of green hydrogen in Namibia. That's another place where renewable energy production is quite blessed, let's put it that way. What is your view on the green hydrogen market ramp up? How will it be funded, and how can emerging economies benefit and participate best in that?
Excuse me. Well, thanks for that question. I think we see the market as being like this flock of swallows, you know, that when the sun goes down, and there's just a swarm of swallows that all sort of fly in unison, but it's made up of millions of them. It's not like one big animal that sort of works in a certain thing, but it's rather a orchestra of lots of players doing all sorts of things. But there are basically three things that when we look at this, that like any business or any market, you need primarily a demand, you need a supply to satisfy that demand, and you need something in between to connect those two dynamics. And the emerging markets has a role to play in all three of those, both the generation of demand, the provision of supply, as well as the dynamic connecting the dots. It's true to say at the moment that the demand, which is driven in large part by things like the obvious push factors, climate change, evidence through policy formulation, evidence through strategies of net zero, turning to regulation. That's really where the main demand pull is, in large part, but the demand is also being created in emerging markets as countries like Namibia, South Africa, Morocco are actually pivoting their own economic plans around a sustainable dividend and a sustainable pivot. So while we think that all the revenues are going to derive from the DMs, the developed markets, and that's the export market for hydrogen generated in emerging markets, it's not exclusively that. We're seeing a lot of demand being driven domestically as they defossilize their own industry, decarbonize their own industries, and start generating domestic demand. So the demand is evolving and emerging in both sides of the south and the north. On the supply side, it's true to say that it's probably dominated by emerging markets. That's where the natural resources are, that's where the energy resources are, it's where the wind, the solar, and the space. So I think that what's also happening there is on the demand side, on the supply side, the physical componentry, the technology, is probably still dominated by the DMs as opposed to EMs, but we are seeing a shift. We are seeing a development and a shift of local technology, local industrialization, and local manufacture, but it's still very much a DM thing as opposed to EM. And I'd say that also on the supply side, financing is probably gravitating more around the DMs than the EMs. There's a shift from donor capital to emerging markets. There's a shift of commercial capital enabled by this type of enabling capital from the north to the south. And so emerging markets have a role to play because some of them do in fact have deep capital markets themselves, like South Africa. Now, the final thing then is this connective tissue. You need something in the middle to actually connect those dots. And that connective tissue is in fact risk. It's a definition of risk, because absent a clear definition of risks, no decisions are made, and if there's no decision made, you don't get the supply to go to the demand. And I think emerging markets have a very, very important role to play in defining what risk means in respect to the sector. And to the extent that that risk can be articulated through the type of instruments that Christine is talking about, equity, debt, guarantees, and across various stages of life, whether it's early stage, mid stage, late stage, or whether the access point is private markets or public markets, that whole Rubik cube that I've described is really a Rubik cube of risk. And if you can define that in a local manner, so the capital will be able to make decisions and the technology will make decisions, and that Rubik cube is very place-based. The Rubik cube for Namibia and Egypt and Namibia and South Africa is different for each of them. And I think they've got to grasp that responsibility, because that's the medium for making these decisions.
Yeah, thank you, Andrew. You really pointed out well what the roles of the various economies are in this effort to transform energy production and also our industries, which are dependent on those. So I'm really interested to hear Deutsche Bank's perspective. I mean, you are the largest financial institution in Germany, but at the same time globally active in many markets. So having heard what Andrew just pointed out, what role does investment in these green hydrogen projects play for Deutsche Bank? And which strategy do you have in helping German clients to transform and at the same time help the market ramp up of the green hydrogen production where that takes place, basically?
Thank you so much. And I think listening to all my previous panelists' outlines, it really underlines that we need all the market participants, including also the producers, to come together and think these projects through, in particular at the beginning. I've outlined already, hydrogen will play a key role for our clients in decarbonizing their own processes. I'm often asked, hydrogen is not a new technology. It's an energy carrier which is around for many, many years. Why do we find it also difficult to finance hydrogen projects? And we've touched on some of the criteria just between the different regions, but there are more angles to the different risks associated. And we are still in the phase where we really come together and need to come together in lighthouse projects to understand the risks associated and how to de-risk and mitigate and distribute those risks. So in the end of the day, hydrogen, when it comes to renewable hydrogen, is really about a large-scale ramp-up of renewable energy, plus electrolysis, and you have the additional risks of either country risks or also project risk, because you have project-on-project risk, and therefore you have dependencies within the project. And for example, we've taken a step 2.5 years ago, and we're one of the founding members of H2 Global, to really address supply and demand in that chain, to take some of the risk out there, because we need, on the one hand side, certainty when it comes to taking investments now, because everybody's expecting advances in the efficiencies of new technologies developing over the next years. So if you now take an investment decision, you want to have price certainty for the hydrogen you're producing. On the other hand side, if you are asked to adapt your processes with large-scale capex, you need to have also supply certainty on the prices for the hydrogen you're getting. So really, one of the things we are seeing as very important is to think supply and demand at the same time in order to ramp up and create a robust market. Secondly, I've mentioned we have various risks. There are still a lot of questions around the transport, about the right derivatives to focus on. We need, and there are a lot of permit issues. There will be time lags in order to have the infrastructure set up, even though we have seen a lot of advances about the hub structures in the different regions. But still, at the first steps, I think we will see, and that's what we do at the moment, we will see integrated projects. So we will see projects which are near site to production, where the hydrogen is being produced very close to the actual end user who's integrating hydrogen in their production processes. So you take out the transport cost and the transport risks for the time being, and can learn just from those developments, because we really need to find projects which are large scale. Successfully scaling up is one of the key risks at the moment, and we are very happy to engage in some projects which are currently coming together, even though we can't speak about them yet. But building that capacity and capability is really key across all the stakeholders which are needed in order to get the financing and bankability across. Because at the end of the day, the projects need to be commercially viable, but at the beginning we need to take these first steps to really learn along the process and get this understanding across.
Yeah, you rightfully underlined projects where the renewable energy is being produced where it's needed, no? Like in Karim's example. I mean, that's a perfect example for such the demand is generated in Morocco itself, and those are the projects which are probably very, very significant and important for this ramp up. But Andrew, let me pick on you once more. We are now getting more into the financing bit, digging into what our clients need in terms of financing for these challenging projects. So which solutions have you developed with your clients, or do you foresee for your clients interested in Power-to-X projects? What are they asking for, the ones interested in these projects? Where do they need your help?
Okay, we think of clients from two perspectives. As a fund manager, we sort of have a duty of care to providers of capital, and then we also have a duty of care to the recipients of those capitals. So let me actually start with the capital end of that question, if I may. So what investors want, they want access. First and foremost, they want access to the opportunity. They read about the opportunity, they hear about it in the credit committees, they see it in the press, and they want access to it. So they can get access through a couple of ways. They can either get on a plane and go meet people, or they can go through intermediaries like banks and fund managers and the likes. The challenge that they have is every organization has a defined risk appetite. And so their journey to the destination is really quite a challenging one, because they don't really know what the ambient risk profile is of that landscape, but they are constrained by their own risk appetite. So what we've tried to do is define that landscape in these certain risk allocations. So we have taken from the world of infrastructure financing 3 defined phases of project maturity, being the development stage, the construction stage, and the operation stage, which is already well understood from a risk perspective. The markets know that the former is more risky than the latter, and there's enough evidence out there to actually try to dimension that. The consequence of that risk is a corresponding return requirement. So we're going to do more risk on more return. That's also well defined. So we've started with that and said, let's create a access point for early stage development, a separate access point for construction stage, and a separate access point for the mature stage. 3 separate funds, but interlinked. In addition to that, within each of those stages, and specifically construction stage, construction is fraught with all sorts of unknowns. You know, you can get the numbers wrong, you can get the timing wrong, get the technology wrong. There are all sorts of things. But you can split that into certain risk profiles as well through an architecture of blending, whereby that risk is shared in a tactical manner. So we've done that as well. So even within the construction stage, we may to bifurcate the risk and give that access to investors. So when we go out and talk to an investor, we actually offer 5 different access points into the same project, which lets different investors type of respond. So currently within our $2 billion, we have roughly 23 investors, and these include 5 governments, 5 development finance institutions, philanthropy, and commercial investors. And they choose which of those 5 seats they want to sit on because it suits their risk appetite. And so that's quite sophisticated. It's sophisticated and it's niche. So as a result, it's quite difficult to scale. And what we've done is we've replicated that model for renewable energy and water and now into the hydrogen space. But it is actually quite effective because it responds to local capital, international capital. So that's what we've offered the product, talking about our clients being the provider of capital. On the other clients being the seekers of that capital, we've sought to fill those gaps which are required, being the development fund and the construction fund. And what we hope to deliver with them is agility, to actually get them the money when they need it. And so through blended finance, we sort of redefined what bankability means. We've said, if you can get a project to this stage and we're part of that journey as a co-developer, we can almost determine and prescribe what bankability means, which is the stage at which our construction fund will then deploy. And so we can get projects into construction a lot quicker. So in summary, our clients, providers of capital, I think we give them access points which suit their own risk profile, and our clients being the seekers of capital, we think we give them money when they need it in an agile way through blended finance.
That sounds like a thought out concept, and also catering for different needs of clients at different stages. And of course, green hydrogen Power-to-X is still an early stage technology, And Christiane, the PTX Development Fund caters for that early stage, and you described how we have grants for R&D efforts, for piloting, but you were also talking about de-risking, and that comes into play when investments get larger. And so what evidence do we as KfW have to gather in order to find the right de-risking approaches when we want to help ramping up green hydrogen production? Can you maybe also look into experience from other sectors in order to kind of draw an analogy here?
Yeah, I think it's at the moment still quite challenging, because I think I wanted to refer to what Lavinia said, and this is about what kind of a market will build up in terms of pricing. I mean, Karim, you mentioned that you have something like a target price already in mind from your experience, from your production, from whatever, and knowing how cheap you can produce energy by wind and solar, which I think is a very, very good starting point. Yeah. But on the other side, we don't know yet, and I think that's one of the really crucial parts. And a lot of those industrial companies that would be interested in buying hydrogens, they would feel still today, I would think they are not yet prepared to sign a long-term contract. Yeah. So we have like this hen and egg problem, the classical one, I'd say, that we have on the one side the producers which want to produce hydrogen, which know something about their costs, some more, some less, but still have question marks on a market, on infrastructure. They don't know yet how to get the hydrogen from the place of production to the client. And on the other side, we have the potential client who doesn't want to and can't write a check because he doesn't know whether he really gets the hydrogen and at which price and at what price. And I think that's one of the core elements here of a very unique risk structure. Yeah, and and I think there probably it will need some form of a government intervention, at least for a particular period of time, to give confidence to potential buyers that they have a de-risking, let's say a de-risking instrument at hand, which de-risks that part of the story. I think, as I said, I think that's for me the core element of the risk at the moment, besides all the technological infrastructure and so on and so forth. Topics we have been already discussing, and I think there it needs some contracts, be it with a blended, be it with a guarantee instrument, be it covering political and or economic risk, really to bridge these, in particular, potential first years of green hydrogen markets. Let's put it that way. Yeah.
If you allow me, just
I was going to
jump on that, because this is a key point here when it comes to de-risking, making sure that you have an output buyer that will come and take the product. And this is where OCP has a very specific position here, because as I mentioned, we are the largest buyer of ammonia. 2 million tons a year, we will reach 3 million tons in 4 years' time. So we can de-risk a part of this ammonia production that we will do. And this is exactly how we want to handle that, because all my co-panelists, they are right. At the end of the day is, okay, are we able to construct the plant? Are we able to produce? And what will be the cost of this production? And when when you are able to make sure that you already deliver plants, you already have all the means in terms of solar and wind, and you're also able to capture the first risk on the first volumes, because the way we are approaching things, this project is, let's start with 200,000 tons of ammonia. And then even if it's 30% more expensive than the gray ammonia, it doesn't matter. We need 3 million tons. We can absorb the difference. And that will help us to de-risk with the financial institution, and also it will help us to start working with technology owners, making sure that we will be able to find the right technology. So the way we will approach that is we will work with several technology owners on small volumes, let's say between 30 or 50,000 tons of ammonia, and making sure that we will find the right technology. Maybe we will co-develop with them, and then from 200,000 we will move to 1 million, and then from 1 million again, having several technologies there in competition, again making sure that we have the right one, and then we move to 3 million tons, and then it's another story. But the key point here is who will bear the risk, the first risk of the first volumes. And this is where we have this specific situation at OCP, because we said we can take this risk and we can manage to absorb that. That's
if I may add to that, yeah, and I think you as OCP, and I think there are not too many others in the world, can play a very decisive role there in building up a market, yeah, or at least getting in the first steps of a market. And I think it will be more challenging. You mentioned some countries which are developing without an industrial basis, yeah, trying to build up their green hydrogen markets, both for their local production as well for export. And I think there it gets way more challenging than when you have an industrial base which can be built. You can build it up on.
I think there's another interesting observation one can make. I'm not sure where the conclusion of this lies, but if you look at sectors that shot the lights out in terms of penetration and acceleration of all forecasts, like telcos, for instance, or solar panels and cost production of those. What both of those evidenced is a aggressive pursuit of miniaturization and fragmentation of deployment. So putting the ability Uber in your hand through miniaturization and digitization. So those are things that have worked well in terms of market creation and market explosion. That's the first point. The second point is the world going forward is undoubtedly more uncertain than the world that was behind. And as a result of that, the tenor of financing tends to come closer. So financing becomes shorter, and therefore one needs to look for models which can actually be deployed quicker and on pieces of equipment that have a shorter useful life. Now, both of these things, these two characteristics, are counter to the mega-scale utility facilities we're actually building in the sector. And the reason why we're building mega hyperscale facilities is because of the urgency driven by climate change. But I think there is an interesting pivot point, which is going to be driven by both technology as well as financing, that it's possible that the deployment of hydrogen in 50 years' time or 30 years' time is going to be miniaturized and going to be in a more sort of regional, if not rural level, as opposed to the big facilities we're building at the moment, which I think will change it quite a lot. I don't know how we get from there to there, but I wouldn't be surprised to look back and see that that's what's happened.
Yeah, that's an interesting connection you're drawing there, like the world becoming faster and faster, and climate change being such a pressing issue that kind of influences the tenors of financings. But of course it's a logic conclusion there. Let me bring Lavinia back into the conversation. So how does that resonate with you, what you've just heard? Like, does Deutsche Bank offer special instruments to respond to growing demand from green hydrogen? And how does Deutsche Bank rate those projects from a commercial standpoint?
Thank you so much. I've briefly touched on it earlier already. So I think in terms of special instruments, when we look into hydrogen, it really requires classical project finance and ECA finance for the technologies involved. Still, the risks we mentioned earlier, we saw that really the initiative from the German government to found H2 Global was a key lever and also a lighthouse internationally recognized to take some of the supply and demand risks out of the system. In order to get the projects bankable, we really need to have long-term offtake agreements, and the insecurities around pricing and production are looked at in those. So we see the first auctions happening in H2 Global on both sides. And clients are very appreciated about that. And also we see the developments with the EU Hydrogen Bank, which are basically following those proposals. So we got actively engaged in those because we saw them as a key lever to overcome these insecurities. Second, what Christiana already mentioned, the PTX platform is really also key in those considerations, because what's actually missing at the moment is equity. We are a debt provider, so we are building on existing equity structures and are coming in for the later financings. And with those, as I mentioned, it's more project finance consideration with the speciality that we have, in many cases, a project-on-project risk to consider. So we have, on the one hand side, the renewable elements, and then also the additional elements of conversions and electrolyzers. And that's really something where we need to build capabilities. So I would less think about instruments. I would more think about capabilities and competencies, and also capacities, really, on all sides. I think we are learning from those projects we are seeing at the moment and getting engaged in. And it's now a matter that we really are seeing developments running simultaneously, because for now we are fine to learn from those projects we are seeing, but we will need a phase in particular with the 2030 targets, which regions have set themselves to overcome and prepare for the next investments needed. So in particular, the adoption of gas pipelines, for example, the whole infrastructure needed to transport the derivatives of hydrogen will really need to be the next step to look into, to mention one.
Yeah, thank you. Yeah, I think we've covered a lot of ground, and this has been an extraordinary active panel, also commenting on each other. I'm amazed and very, very happy about that. But now it's time also to ask our audience, are there any questions you would like to ask to these panelists? And there's a microphone coming. Yeah? Wonderful. And here the lady in the first row.
Thank you very much for the comprehensive and insightful perspective shared on green finance by such experts from DFIs, producers, commercial lenders, and funds. You've already touched upon this question, but if you can summarize, like, what are the key technological developments that are required to reduce the cost of green hydrogen? And if different financing structures are necessary to support those innovations.
Who would like to take that one? Karim.
Yeah. Actually, what makes those projects, first of all, I would like to say that the financial community is really, really willing to invest. But then the second step is in which conditions. And we talked about the risk. So we have different types of risk. The first one is the technology. The technology is not yet there in order to produce at scale. I think, if I'm not mistaken, probably the maximum volume produced in one plant so far is between 100 and 150,000 tons, and here we are talking about millions. So the technology risk is still there. At OCP, we feel confident because we run many roadshows and we are in discussion with many technology owners, and we have our own R&D. So we feel that in a short period of time we will be able to find solution, especially on the electrolyzers, because when it comes to solar energy and wind energy, this is something that already under control. The cost of production of those energy are very low today compared to where they were in 10 years' time. So it's specific to the electrolyzers. And from that point of view, then it's about how you convince your financial partners of your ability to fix or to find the solution. And of course, from that point of view, as long as the technology is not yet proven, it's more about being confident or not by working with someone. From OCP point of view or angle, we feel pretty confident. We have some support from that aspect, but as Christiana mentioned earlier, I think that in terms of financing, it's time today to have more public finance, more grants, and then the private sector will come. And also from a producer point of view, we need to be more transparent, because those guys need to have some inside information to be reassured on how the things are moving and doing, and this is where I think, and this is what my co-panelists said also, we need to work together and to share where we are going, at which stage are we. And finally, what I would like to say as well is what Robert mentioned in terms of flexibility, having people that can finance in different stage of the project. That's also very, very useful, very helpful, because then you don't have to take all. You can choose, and depending on how you are viewing the risk and which type of risk you want to take, then you have different finance institutions behind. That's something. Exactly.
I would love to underline what Karim said. I think the major issue is really about scale. So finding large-scale industrial-sized production, but also being able, oh, I think I lost the mic. Does it work? No? Okay, sorry. Having large-scale industrial-sized production, but also proving the integration into industrial processes. So it really is on both sides still at large scale something where the proof points are still for us to look for. So once these advances are made, that's going to be a major step forward. Secondly, it's really about efficiencies. So it's to be expected that the electrolysis capacities and efficiencies will go up. And if you look into research, it's also very easily predictable that green hydrogen prices will come down in production in comparison to all others. So those advances are foreseeable. I think we are on a good track there. But really scaling up and having that in those amounts and sizes which we will need in order to achieve, it will really require to think holistically, because it doesn't only require production in those countries which really have like the benefit of all the natural resources to produce renewable at large scale. It will require all viable solutions to come together, because we will also have to overcome the transport issue for some time and the costs associated with transport.
So I'm going to take a bit of a liberal use of the word technology, but I think there are two features about this market which are quite unique. One is the role of common use infrastructure, in that unlike other type of assets and markets, the dependency and interconnection between common use infrastructure between different projects and the dependency on it is much more integrated, and I think we need a standard and scalable way of financing and procuring common use infrastructure. The second thing is there is no EPC wrap in this. You know, you can't wrap a wind farm with an electrolyzer with an ammonia and with a pipeline. So for the financial markets, trying to get their head around a split contract aggregated model which manages the interfaces is fundamentally important, because if we wait for a wrap, it's never going to happen.
Okay. Are there more questions? Yes, please. No, first you, and then pass it on, please.
Thank you so much. My name is Felicia. I work as Chief Finance Officer at Rwanda Green Fund, which is actually a fund that is trying to use like a branded model in terms of financing those green and technology initiatives. We have started one of the fund, and now we have capitalized about 270 million USD. That is having a guarantee side. It has grant side, but also it has a credit line. Why I'm why I'm going to state that is that when you're looking like MDPs and development partners, looking which structure that can make the cost of finance accessible. I mean, even to leverage the private capital to come. We are not seeing maybe a lot putting money in in the grants to make sure actually they are de-risking those commercial loans actually to attract them to come to finance a certain project. So maybe I want to ask on the fund manager side, is there now like a proposed combination structure in terms of optimization of financing those kind of projects? Maybe what kind of percentage do we need in terms of maybe like grants versus loans or even guarantees, so that actually we can make like a reference case. That is first. The second is also how I mean, development banks like KFW can also, I'm trying to ask KFW side, can maybe like allow instruments that is simultaneously have an objective of bringing maybe the private capital, what kind of maybe leverage ratio sometimes you are looking so that maybe we can bring also those private capital providers on board. Thank you.
Maybe we take these questions, or maybe you ask your question as well, please.
Okay. Yeah, firstly, apologies. My name is Pradeep Tharakan. I'm ADB's Director of Energy Transition. I was supposed to be on that panel. The last one finished in the other end of the world and then just getting here. But I'm so glad that I missed the panel because I'm able to sit here and actually listen. But just briefly, I think as from the development bank's standpoint, and you know, I think the panelists, you talked about two major types of projects, right? You've got the very large export-oriented projects, and NEOM's a great example, but it's a very unique example. You've got a massive sovereign behind it, you've got all of Saudi Arabia's solar resources, and you've got a long-term offtake contract. Countries like India are talking about these sorts of projects, and we are beginning to look at some of them, and there are so many questions we have. I mean, we've talked about all of them. The second is sort of, you know, produce it where you use it. I think the H2 steel project in Sweden is a great example. And as you mentioned, there are some good, you know, sort of innovations around where some of the off-takers are now equity holders, so they get an upside. Karim, you went as far as saying we can manage the risk by supporting, but you didn't go as far as saying maybe we could even take an equity stake, you know, so that if the price goes down, at least you've got an upside from the generation. But the third element, and I think it was briefly mentioned, is smaller decentralized hydrogen projects. It'll be good to hear. I mean, in the power sector, we went through this whole circle, right? We built massive centralized projects, and then we said, oops, we got to go back to decentralized, closer to demand. I wonder if you're missing that loop in hydrogen by focusing only on the first two. And as a development bank, and you know, KFW and us ourselves, is there an opportunity for biomass to hydrogen for development impact, you know, in the developing world? And just wanted to get some. And then what are the issues? Because those are going to be project finance. You've got smaller players, harder to, you know, get credit and all of that. So it's it's not a question, it's more of a comment.
Yeah, but thank you, Pradeep, for coming and joining us. And you're such a loyal friend now, asking all your questions and making your contribution this way, which we missed a lot on this panel. But yeah, I can very much empathize with the distances you have to cover on this campus. So don't worry about that. Thank you for your question. So who would like to start on which question?
So I'll take the one on how much donor capital do you need? And this is tested repeatedly in blended finance architectures. There's no single answer, I'm afraid, but there are a couple of guidances. One is the earlier stage you are in the project life stage, development, pre-fees type of stuff, the more development capital you require and grant capital, and the later stage, the less you require, if indeed any. Broadly speaking, the industry standard is around about 20% from construction stage onwards. the most you need is probably about 20%, because you should be able to get your forecasts pretty much accurate enough to 20% up or down. You should. Now, the other guidance is that donor capital doesn't want to go it alone. They want to see a mobilization characteristic, and the expectation out there is probably about 8 to 10 times. So every dollar of donor, you need to go and mobilize, which means that the risk profile of the project at that point in time, or in that jurisdiction, all the technology you've got to, is still going to be sufficient for your 80% and your other $7 that you've got to augment to it. So there's no single answer, but it's within that parameter.
Yeah, maybe on Pradeep, but I think you have described it so very accurate and very knowledgeable. Yeah, I think it's 3 groups, and as you said, and I can only agree on that. And on the last part, that is really an interesting question, yeah, as you phrased it. And I think, as you said, there is no definitive answer. I think it's worthwhile thinking about in that direction. Yeah. Because, I mean, let's look at it from another point of view. I mean, if you started to more develop a country towards an industrialization, it would be very good to start from the very beginning, thinking of the green hydrogen perspective. If you got one on your country, I think it all depends how your wind and solar how your land is and how good it is for wind and solar. Because, I mean, let's get clear. I mean, green hydrogen without a very efficient and very good location for having wind parks and solar wouldn't work. Yeah. So I think we will see countries which are very close to that setup, and we do see countries which just don't have that. Yeah. Don't have these resources in terms of good opportunities for wind and solar. And I think in that sense, what all you were describing, I think even if you go layer down, you have more scenarios as much deeper you dig into the matter. Yeah. And I think we don't have yet an answer to all of that. But I think what I think is important, that in particular the 2 first groups you were mentioning, the bigger industrials and the places and hydrogen, not for export but more for local, I think we have to start somewhere, because I think it still needs more knowledge in terms of technology. It needs more knowledge in terms of how market develops. And I think there's nothing about it than just moving ahead and starting it and learning from it by experience. Yeah. But I think we will see way more diversified market and regions in the decades to come. Yeah. I think it's more a question of decades, not of years. Yeah.
I would love to add to that. I totally agree. But also, I think just in the small scale on-site production, decentralized production, I think that will be the way how to overcome really the investment challenge we will have for the transport element. So the whole infrastructure questions, because they will take so much time with regards to permitting, also developing those technologies what are needed. So while I think the whole hub logic, which is becoming clearer, makes a lot of sense, it will take some time. And on the way, I think apart from the large-scale projects, we will see some local decentralized developments happening. But I agree fully with Christiana. We have at the moment really also still the learning need across the industry to learn from the large-scale projects we are coming together now.
Maybe just to mention 2 things. First of all, we are in the equity, as OCP. we are developing that, so we are part of the game. But what I would like to tell you about those small-scale projects, actually, to produce hydrogen is very, very energy intensive. So you will need, and especially if you want to produce it through the solar energy and wind energy, you need a lot of huge number of lands in order to be able to produce at scale. So this is why I don't think that as far as the hydrogen with the actual technology or the one we are working in, it will allow us to have small production of hydrogen. You will have like the NEOM or IDEAL or what we also have already announced. If you have to make it at scale if you want to be competitive. Otherwise, it will be difficult. And then you have also the question of the transportation. But from that aspect, the good news is the shipping industry maybe will be able to swift and to start using green ammonia as a carburant, which can also help. But pipelines, at least from Morocco perspective, it will be more focused on a pipeline from Morocco to Europe in order to solve this transportation issue.
Pradeep, is there anything else you would like to add?
Oh, no, I would
Is
love
there-
more information on the PTX platform, but that we can take that offline. No
Oh,
worries.
okay. All right, more questions. I saw a couple of more hands. Yeah? Yeah, and the lady first, and then you pass it on to the gentleman sitting.
Yeah, sure.
Yeah. No.
Okay.
Please
yeah,
go
I will.
ahead. Yeah.
Hi, thank you so much for the panel and all your insights. My name is Imogen Outlaw from New Climate Institute based in Cologne, Germany. And my question is, I think we've touched on this slightly, on kind of the sustainable development aspects. I think there's a lot of countries right now that are coming out with different hydrogen strategies, and they focus not only on the decarbonization potential, but really on the benefit that this can bring to the country. And the question I have is, particularly when we're talking about public finance and the role of public finance here, how can public finance, or what role should public finance play in ensuring domestic value creation in these countries, and kind of ensuring that there is some kind of value chain created in this country, particularly if we're looking at a case like Namibia, where there is not really an industry or demand at the moment. And second question I have is, again, we're talking a lot of the strategies right now are really focused on export. I guess this is more of a comment of, do we think that there will be appetite for only kind of raw, if you allow me to use that term, raw H2, raw green hydrogen, or will we also see in the future appetite for products, importing products that are maybe of higher value creation for these countries, like green steel, et cetera?
Right away.
Yes, please.
Hi, my name is Till Tresker. Thank you so much for the insightful discussion. You talked about how the scale-up of production and increased efficiencies when it comes to technology really helps to bring down production costs in the future, or are expected to bring down production costs. I wonder how much of a dilemma does this actually create, and what is kind of like the notion you get when talking to developers when it comes to like whether one should wait for these technological advances to actually take place and then start production in, let's say, 10 years.
And maybe you pass the mic to the gentleman sitting in front, yes? And that's the last question I will take then. So please, go ahead.
So, first of all, thank you very much for this panel. So, as you know, the green the green hydrogen sector is emerging markets. So, from the perspective of the commercial bank and financing, are you looking the Power-to-X project as classical project finance? And do you need to assess all the risk, or you are already more flexible, and you could accept less risk without impacting the cost of financing? And what kind of risk that you could accept compared to the classical project finance?
Maybe I start with the question of the young lady. Well, without sounding a little pessimistic sometimes, but when we travel the world quite a bit and with customers and partners in more than 100 countries, and what sometimes makes me a little nervous is there's barely not any country, not one country that doesn't talk about green hydrogen at the moment. No matter how good the perspectives are and how good the potential business case might be. And what I mean by that, you raised some of the issues, is there a good spot for wind? Is there a good spot for solar? Is there any means, not only in terms of financial capabilities, but in capabilities to set up these projects from a technical point of view, from a project management point of view, yeah? And that makes me sometimes a little nervous, because what I would be nervous about is that countries not having these expertise and knowledge trying to do that, and then end up in a way that all these projects are in the hand of others, because they don't have their own means of really making their decisions on it, and so on and so forth. I mean, there is something about it, as I said, which makes me nervous. I mean, I think you still have to move forward, and if you want to create your future, you sometimes have to take certain risks. But I think from an overall perspective, it would be, at least in theory, good to focus on those countries and on those business cases which are most valuable and probably show the best value. Start from there and not start with the most difficult circumstances and the most challenging perspectives. It's a very generalizing answer, but really, I mean, there's barely not one country that doesn't talk about green hydrogen at the moment.
I think public sector capital should be spent in those areas where the benefit is shared amongst many. So common use infrastructure, studies that go to resource studies, permitting, land use, policy, that's where I think it should go. And I think it should also go on the peripheral of the main core infrastructure themes. I'm going to come back to your project finance question, is that I don't think the private sector needs public sector capital to stitch together a project finance plan. We know how to finance these things. They're interfaces that we can get our heads around. So there may be some spongy money that's required to actually manage the risk between an interface, but I think it needs to be in the early stage, and it needs to be on the peripherals of it, so that governments don't buy molecules, or they shouldn't. It's not the molecule they're going to buy. They need to maybe facilitate the passage of that molecule into the impact it's got to deliver. I want to pivot to your question. Is it pure project finance? I don't think it is. If you look at the funding structures of these projects, there's public sector support all over it. There's public sector support in the revenue line through not debt financial swaps, I've got these on my brain, for contracts for difference. Donor capital, it's going in. MDB money is going in via sovereigns with a guarantee. If you unpick it, yes, a lot of the liquidity is coming from the private sector, but a lot of the support and the credit enhancement and the certainty and the risk allocation is actually going to the public sector balance sheets. So is it project finance? Well, not really. Project finance is meant to be zero or limited recourse. There's not a lot of limited recourse in these first projects.
I just maybe answering the young guy there. In terms of, if I understood well, your question is, do we first have to develop the technology and to see at which price we can produce and then start investing? And I would answer, it's all about incentive. Are you incentivized to do it quicker or not? And as the OCP group, we are very incentivized because, first of all, we have a clear sustainability strategy. We want, as I mentioned earlier, to be net zero carbon by 2030. And also, we do believe that we can produce green and at more competitive cost than the gray of today. And by having being sure of that, this is why we are committed to work on it and trying to be able to produce as soon as possible. And actually, we ask ourselves the same question. Do we have to start with 1 million tons, or do we have to start with lower volumes and then look at the technology, or do we have to wait until the technology is proven? And what we decided to do is let's go and learn and try and make it at industrial levels, because 200,000 tons, it's pretty good levels. And from that, it's exactly what happened in the photovoltaic business and the wind business. I mean, they started, the cost was 10 times what the cost is today, and it will be the same. But for that, you need an industrial ecosystem, and you need also the output buyer. This is where we have this key role to play as a group.
Maybe just briefly adding to that, to your question, because you really hit one of the key concerns also with your question. And one of the answers are really systems like H2 Global or the European Hydrogen Bank, because they are, at least for the beginning and for the first volumes, taking out that risk and are contributing to that price and are helping to set a price target which helps the producers to have some clarity around their production cost, but also guarantee the supply for the demand side.
Okay, thank you very much. So I would like to close the session, since our time is up, by thanking this very engaged, very active, and very cooperative panel. Commenting on each other. It was a joy really moderating you, and assuring you as well that we have taken away some very valuable insights on the opportunities and challenges of transforming to green hydrogen. We have learned, for instance, we've learned lots of things, but for instance, advances in technology are still needed, and we have financing instruments in place in order to help with the early stage, and climate fund managers has a very well thought through financing instrument in place, helping at various stages of project development. Deutsche Bank commented project finance is really what's needed, really non-recourse, but in this industry also the government assistance is very much needed at this stage still. We learned that emerging markets, not only can they supply, but of course they can benefit best if they create the demand at home, and we've seen a very good example of that from OCP in Morocco, how the vision is there to use the green hydrogen derivatives at the spot. And we have learned that integrated project concepts are crucial. And because sometimes transport is involved, sometimes it's not. So let's all work towards grasping the opportunities and working on moving away the existing barriers. Hopefully this sector will advance quickly. And with that, I would like to conclude. Thank you very much, and also thank you for your very good questions and your contributions from... Yeah, exactly. That is, it was really perfect today. Thank you very much.
And you weren't planted, were you? You just have to beat it.
Institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox including GHG accounting, climate risk assessment, Paris Agreement alignment, and climate strategy, offering trainings on climate risk assessment, climate strategies, and adaptation, supporting events and partnerships to the international agenda, mobilizing resources and facilitating joint business opportunities and project proposal. IDFC Climate Facility. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC? The International Development Finance Club, created in 2011, is a network of 26 public development banks. Our mission? Speaking with a common voice, to leverage a greater impact in major international debates, and to contribute to the implementation of the SDGs, the Paris Climate Agreement, and the Kunming-Montreal Global Biodiversity Framework. Our goals? Knowledge sharing and capacity building among the IDFC institutions, enhanced collaboration between members and partners, and pursuing advocacy on the role of public development banks. How does it work? All year long, the club is working on contributing to the international agenda, coordinating working groups on SDGs, gender, climate, and biodiversity, releasing common strategic and operational publications, and reporting their annual commitment towards climate and biodiversity. IDFC. Let's work together to implement the Sustainable Development Goals towards 2030 and beyond. What is IDFC Climate Facility? Created in 2019, the facility has been supporting IDFC members in enabling knowledge exchange and offering capacity development on climate-related topics. Our 3 goals: to strengthen climate finance expertise and capacities, to originate and develop joint climate projects, to institutionalize and facilitate collaborative work among members on climate change. Our activity lines: knowledge sharing, capacity building, access to international climate finance, joint business opportunities. In the past couple of years, the IDFC had been supporting members in mainstream common principles on mitigation and adaptation, developing a framework for the operationalization of the Paris Agreement alignment, promoting a mentoring program between institutions, delivering climate toolbox